What goes up must come down, right? And stock market has certainly been going up a lot lately, and now there's the talk of correction on Wall Street. So let's bring Doug Flynn in today. Market's down today. Flynn Zito Capital Management, to see if this is the start of something. And we pop it up, guys, from the tablet on what some of the big investment houses on Wall Street are saying. Both Goldman Sachs and Morgan Stanley saying, we could pull back here 10-20%. So that's the question. We've been kind of wondering about this for a while. How do you see it?
Yeah, well, saying we're going to have a 10 to 20% correction in the next 1 to 2 years is basically saying nothing, because if you go back 100, right? If you go back 100 years in the market, you basically have a 10% correction once, every 1 to 2 years. So they're just saying the obvious, and it's very normal. And if you have those pullbacks in a normal, healthy, growing, long-term upward environment, that's fine. It's just those big unknown catalysts that, could be something much greater, like if we're talking about the, a recession or the financial crisis and things like that, where you do have more of a concern. But short of that, those pullbacks are healthy.
Let me talk about that. We'll show some numbers first. I'll just put a chart up of the stock market, S&P 500, and where it is, because it's the broadest measure of the market. So that's what we're talking about when we say that the market's been running up. So there you go. Yeah. Now, back in time, 95 to 99, when the internet bubble was being blown up, so to speak, the S&P went up almost 200%, and the NASDAQ, of course. Remember, NASDAQ 5,000 was a big story. NASDAQ went up 440%. But then after that, down we go. Almost 50% down in the broader market. NASDAQ lost 80% of its value nearly. And then we've had these gains over the last, really, 2 years in the market, 70 or 100%. If you look at the S&P and the NASDAQ. So now what's the next slide going to be is the question, and how do we know what signs to be looking for?
Yeah, so the market is overvalued, which is where a lot of these comments are coming from. And why it's overvalued is because when you look at like the 30-year long-term historical measure we use to determine like fair valuation of the market, that's called the price to earnings multiple, and that's assigned about a 17 level. Well, right now we're at 23. And so the way to think about that is we're 33% overvalued to the long-term historical norm. And it's even further than that, because it's really concentrated. If you take the S&P 500 and break it into the top 10 of those, and then the other 490, those top 10 their earnings multiple is 31. It's basically twice the long-term historical average, and the other 490 is still overvalued. So that's where this is coming from, is like there are some overvaluations. Now, if the earnings rally up, which we're seeing, then that will kind of help with the valuations. And a pullback would be normal, and then perhaps we're still in a longer-term upward trend. But the problem with those charts that you just showed is that a lot of people, because they may have missed the last year or two, they want to come in now. And then if you do, and then you have that downturn, you have to be very careful with money you might need in the near term, chasing it after the run you just missed, as the people in the late 90s learned a very hard lesson. And that downturn was from 2000 to 2002. It was 2.5 years of a downturn, and then you had to make it all back. So you just have to be careful with short-term money after those.
But you do make it all back. And I think that's also the point here. We've talked about this many, many times, that the split, there's those losses, early in the century after the NASDAQ bubble burst. You do make it back over time. So what do you tell people about that? Because I've been on this, this kick that the big separator of this country right now is between people who are invested in assets like stocks and people who are not, in terms of how they're better off, because the market always goes up over the long term. It never goes down over, say, a 20-year stretch. So what do you tell clients who come in about this? It depends on their time frame. It's got to.
100%. And also we have to remember that the last 3 years have been good, but let's just go back to 2022, which is not that long ago. No. The S&P was down 18 and the NASDAQ was down 33%, and that was just a couple years ago. So the way to think about that is, if you come in now and you have a minus 18 or a minus 33 if you're chasing the tech stocks, can you withstand that? Will you stick with it? And if it's not money that you will stick with through that return and then ultimate long-term benefit, then don't put it in there. But if it is, then that's fine. It may go down before it goes back up, because like you said, long-term, you can't bet against great companies that are well-run, that are good citizens, and they're trying to be profitable. Maybe there's a shift to communism in New York City, but it isn't going to change Wall Street and that end of it for capital capitalism and making money for the shareholders longer
Democratic
term.
socialism to you, Doug. Now, watch
I'm
your,
sorry.
You know, but
That's where it starts.
But no, but that's the point. But whether it's that, whether it's the market crash in '29 or '87, or whether it's what we had, we all remember in '08 or '09. We always get through it over time, always, and you always make money betting on this country and this market over time. So that's it. I got to go now, Doug. But
okay, you got it.
And now everyone's going to wonder what that point is, but he's going to have to wait till next time he's on. He's on all the time. Thank you, Doug.